Simple Investing Laws. 90% of people ignore this. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Everyone wants to be rich, but almost no one wants to be boring. That's the paradox at the heart of wealth. Because in reality, the path to financial freedom isn't dramatic or secretive or reserved for the brilliant. It's repetitive, quiet, and profoundly simple. But simplicity gets ignored because complexity feels like progress. So people chase. They react. They drown in information, while the ones who build real wealth play a different game entirely. This book is about that different game. It's not about predicting the next market boom or decoding economic forecasts. It's about mastering the timeless principles that quietly compound into something extraordinary. Not because they're revolutionary, but because almost no one sticks with them. In a world that rewards speed, these principles reward patience. In a culture obsessed with hacks, they honor habits. The irony is that the rules of wealth haven't changed in 100 years. Spend less than you earn. Invest the difference. Stay the course. Ignore the noise. These aren't secrets. But just like diet and fitness, the challenge isn't knowing, it's doing. The hardest part isn't access to information. It's resisting the urge to outsmart something that doesn't need to be outsmarted. This book is not a blueprint for the next big thing. It's a system for the last enduring things. You'll learn why your margin, not your income, is the real engine of investing. Why staying invested matters more than market timing. Why boring portfolios beat brilliant ones. Why automation is the most underrated superpower in finance. And why the greatest investment you'll ever make isn't in a stock, it's in yourself. The late John Bogle, founder of Vanguard, said it best. The secret to investing is that there is no secret. The people who build wealth don't chase brilliance. They embrace consistency. They don't get seduced by noise. They build systems that run without emotion, and then they let time do what time does best, compound. This book is your permission to stop chasing and start building. It's not designed to excite you. It's designed to free you. Because once you stop reacting to the market and start operating by principle, the path to wealth becomes simple, even if it's never easy. Let's begin. Chapter 1: The Illusion of Investing. Two friends. Same age. Same income. Both start investing at 25. One chases headlines, stocks that double overnight, crypto that promises 10x returns, and advice from influencers who scream in all caps. The other, he invests quietly in low-cost index funds, rarely checks his portfolio, and ignores financial news. 20 years later, their portfolios tell the story. The first friend made exciting bets, but the excitement came at a cost: missed timing, emotional selling, and scattered returns. The second friend, steady and unshaken, quietly watched his wealth compound, turning ordinary habits into extraordinary results. This is the illusion of investing. It's easy to mistake activity for progress, complexity for intelligence, and noise for value. But investing isn't about what's thrilling, it's about what's true. The truth is, most people who invest are really just hoping to get lucky. They're not following a plan, they're gambling. The illusion is reinforced everywhere. Financial entertainment networks talk in urgent tones. Social media rewards bold predictions. Everyone seems to have a hot take or a secret strategy. Meanwhile, the most successful investors live in a different world, one of boredom, consistency, and patience. Their portfolios don't trend on Twitter, but they grow, quietly and relentlessly. A common mistake is believing that success comes from finding the next big thing. This belief leads to frantic behavior, jumping from one trend to another, watching markets daily, and trying to time the perfect entry and exit. But the market punishes emotion. Every next big thing feels like an opportunity, but most are distractions. The real opportunity is staying the course with a plan built on timeless principles. If investing were about intelligence, the smartest people would always win. But studies show that even professionals often underperform the market. Why? Because investing isn't a game of IQ, it's a game of behavior. Those who stay disciplined during downturns and don't get greedy during booms outperform those chasing brilliance. True investing is almost boring. It's setting up a system that runs with or without your attention. It's choosing simplicity over complexity, process over prediction, and principles over panic. That's why the illusion is so seductive. Boring doesn't sell, but boring work. The difference between illusion and reality is subtle but profound. Illusion says, be smart, be fast, beat the market. Reality says, be consistent, be patient, follow the plan. One path leads to drama. The other leads to wealth. You don't need to be a financial genius. You don't need to guess the market's next move. You need margin, the space between what you earn and what you spend. You need time, years, not months. You need simplicity, a strategy you can stick with. And you need the humility to ignore what most people chase. This book isn't about tricks or hacks. It's about timeless laws. Laws that don't change with the news cycle, laws that work quietly in the background, while others get distracted by noise. If you understand and apply these laws, you'll build something that most people never do: lasting wealth. It starts by rejecting the illusion. It starts by embracing what works, even if it doesn't feel exciting. Because in the world of wealth, excitement is often the enemy. Clarity, simplicity, and consistency, that's the path. The friend who chased headlines may still be looking for the next big thing. The other friend, the quiet one, is reaping the benefits of patience. Same income, same market, different mindset. The choice is yours. In the next chapter, we'll look at the first and most powerful law of real investing. It's not about stock picks or interest rates, it's about behavior. And it starts with a single word: margin. Chapter 2. The margin is the magic. Spend less than you earn. Wealth doesn't begin with investing. It begins with margin. Margin is the space between what you earn and what you spend. Without it, there's nothing to invest, nothing to grow, nothing to compound. You could make $1 million a year, but if you spend it all, you've built nothing. You're running in place with a fancy view. Many confuse income with wealth. But income is just speed, margin is direction. A 6-figure salary looks impressive, but if it comes with 6-figure expenses, it's a treadmill. The people who quietly build wealth don't always earn the most. They simply spend less than they earn and invest the difference. That difference, however small, is the seed of everything. It sounds simple because it is. But simple isn't the same as easy. Creating margin requires discipline, intention, and sometimes sacrifice. It means resisting lifestyle creep, the tendency to upgrade spending as income increases. It means learning to find satisfaction in stability, rather than chasing status. The financial world often skips over this part. There's more excitement in discussing ETFs, asset allocations, or market trends. But without margin, none of it matters. A brokerage account full of flashy tickers is just theater if it's funded inconsistently. Margin is the lifeblood of real investing. It's the only way to feed your future without starving your present. Consider 2 households. One earns $80,000 and spends $75,000. The other earns $50,000 and spends $40,000. Which one is wealthier? Over time, the second household wins, not because they earn more, but because they have more to invest. Their savings rate, 20% versus just 6%, becomes the difference between compounding and coasting. This is the essence of margin. It multiplies your options. It buys freedom, not just stocks. It gives you the ability to invest during downturns when others are panicking. It gives you time to wait for better opportunities, to take career risks, to weather storms. Margin makes you resilient in a world that punishes the overleveraged. Creating a margin doesn't require a radical overhaul. It starts with awareness. Track what comes in and what goes out. Find the leaks, the subscriptions unused, the purchases forgotten, the conveniences that cost more than they return. Budgeting isn't punishment, it's permission to tell your money where to go instead of wondering where it went. Then automate your margin. Pay yourself first by transferring a set amount or percentage into savings or investments the moment income arrives. Make it invisible. Make it untouchable. What remains is what you live on. This flips the equation from save what's left to spend what's left, and that shift is powerful. Margin isn't about deprivation, it's about direction. It doesn't mean cutting out everything joyful. It means cutting out what's forgettable so you can fund what matters. The small, consistent margin you create today becomes the freedom you enjoy tomorrow. Wealth doesn't happen all at once. It happens in the quiet moments when no one's watching, when you choose to walk instead of sprint, when you choose to wait instead of impulse buy. Margin isn't glamorous, but it's what makes everything else possible. If you ignore this, the rest of your strategy will collapse. You'll invest inconsistently, you'll sell in fear, you'll stay one emergency away from disaster. But if you protect your margin, everything else builds from there. It's the soil from which wealth grows. In the next chapter, we'll explore how time, not timing, becomes your greatest ally. Because once you have margin, you can finally put time to work, and that's when the compounding truly begins. Chapter 3: The Time Game, Staying in the Market Long Enough to Win. In the world of investing, time is the great multiplier. Not timing, the futile attempt to predict short-term swings, but time itself. The longer your money stays invested, the harder it works for you. Not because markets are predictable, but because compounding doesn't care about headlines, it only cares about duration. Imagine two investors. One starts at age 25, investing $200 a month and never stops. The other waits until 35 and doubles the contribution to $400. At retirement, the first investor often ends up with more, not because they invested more, but because their dollars had more time to grow. This is the quiet power of compounding. It's not linear, it's exponential, and it rewards the early, the patient, and the consistent. The myth of market timing persists because it flatters our desire for control. If only we could buy low and sell high at the perfect moment, we'd win big. But studies show even missing the 10 best days in a decade can slash your returns in half. And guess when those days often come? During the scariest downturns. When emotions scream get out, those who stay in are often the ones who benefit most. The real danger isn't market volatility, it's investor behavior. Fear and greed make people jump in and out, chasing performance and fleeing losses. But the market punishes those who flinch, it rewards those who endure. The average investor drastically underperforms the market because they try to outsmart it. But the secret isn't outsmarting the market, it's outlasting it. Every dip feels like the exception, the one crash that will undo everything. But the market's history tells a different story. Recessions come and go. Bear markets arrive and pass. Yet over the decades, the general direction is up. Not in a straight line, but in a jagged climb that favors those who don't blink. Time in the market also neutralizes risk. In the short term, returns can swing wildly. In the long term, they flatten out. The longer your horizon, the more predictable your outcome. That's why time is more valuable than timing. Timing is gambling. Time is gravity. It pulls your portfolio upward if you let it. This is why starting early matters. But if you're starting late, don't panic. It's not about when you start, it's about how long you stay in. 10 consistent years beat 30 years of jumping in and out. The market doesn't reward flurries of brilliance. It rewards long stretches of discipline. Your job isn't to predict the next move. It's to stay in position. To keep investing through the noise, the fear, the excitement. Time rewards the boring. The ones who contribute steadily, rebalance occasionally, and don't obsess over headlines. While others react, you accumulate. That's the irony. The greatest advantage you have is one most people overlook: staying put. It's not dramatic. It doesn't make for exciting conversation, but it works. The investors who win are the ones who treat their portfolio like a tree, not something to be uprooted every season, but something to be watered, left alone, and allowed to grow. Time is what transforms small decisions into massive outcomes. It's what turns ordinary discipline into extraordinary results, and it's available to anyone willing to wait. You don't need to guess the next boom, you just need to be present when it happens. In the next chapter, we'll simplify what most people overcomplicate. Because once time is working in your favor, the next step is designing a portfolio that you can live with and stick to, through every season. Simplicity isn't just elegant, it's effective. Chapter 4: The Simplicity Principle. Diversify, then simplify. Complicated feels intelligent. A portfolio full of hand-picked stocks, ETFs, and trendy sectors looks impressive. But impressive doesn't equal effective. The truth is, complexity often hides fragility. The more moving parts you have, the more likely something breaks, or worse, causes panic when it does. Simplicity, on the other hand, is resilient. A portfolio that's easy to understand, is a portfolio you're more likely to stick with. That matters more than optimization, because even a perfectly engineered plan collapses if you abandon it during stress. Investing isn't just about what performs best on paper. It's about what performs best in real life, under emotion, uncertainty, and time. Diversification is your first line of defense. It spreads risk across different asset classes, stocks, bonds, perhaps real estate, so no single event can sink your entire strategy. But diversification doesn't mean grabbing every option on the shelf. It means thoughtful exposure. For most, a total market index fund paired with a bond index fund does more than enough. This simple mix captures thousands of companies across industries and geographies. You don't have to guess winners. You own the market, and because the market grows over time, so does your share in that growth. Bonds, meanwhile, provide stability. When stocks drop, bonds often hold firm. They balance the emotional roller coaster. Together, they form a quiet, powerful engine. The temptation to add complexity comes from the desire to beat the market, but most who try don't. Study after study shows that active investors, those constantly tweaking, picking, and shifting, often underperform passive ones. Not because they're less informed, but because the game isn't about picking right. It's about staying put. A simple portfolio is easier to automate, rebalance, and understand. If you know what you own and why you own it, you're less likely to bail during turbulence. Clarity creates confidence. And confidence helps you stay invested. That alone boosts long-term returns more than any clever allocation ever could. Even professionals use simple strategies. Many target-date retirement funds, used by institutions and pension systems, rely on basic allocations that adjust over time. They don't try to outsmart the system, they align with it. You can do the same, and by avoiding unnecessary trading, you also save on taxes and fees, silent killers of performance. Simplicity doesn't mean one size fits all. It means intentional design. Your mix of assets should reflect your goals, risk tolerance, and timeline. But once that's set, resist the urge to tinker. If your plan is built well, it should be boring. That's a feature, not a flaw. There's a reason simplicity works. It's durable. When the market swings, a complicated portfolio invites doubt. Which piece is failing? What should I sell? Should I pivot? Complexity breeds confusion. Confusion breeds inaction, or worse, panic. But a simple portfolio? It just sits there, unmoved, unbothered, working in the background. This is the principle behind diversification and simplification. Diversify to spread risk. Simplify to reduce stress. Together they create a plan that doesn't just perform, it endures. And endurance is the true measure of a portfolio's strength. You don't need 10 funds. You need 2 or 3 that do their job. You don't need to follow market trends. You need to follow your plan. That's what separates investors from speculators. Investors build. Speculators chase. In the next chapter, we'll take this one step further because even the simplest portfolio can fail if it relies on willpower. The best investors don't just build a plan, they automate it, and that automation becomes their superpower. Chapter 5: The Power of Autopilot. Automate or abdicate. Every January, millions make financial resolutions. By February, most are forgotten. Not because the intentions were wrong, but because the execution depended on willpower. Willpower is a limited resource. It fades under stress, emotion, and decision fatigue. That's why the most effective investors remove willpower from the equation. They automate everything. Automation isn't just convenience, it's strategy. It builds discipline into the system so you don't have to summon it daily. Savings, investing, rebalancing, they all happen without needing to ask, decide, or remember. In a world that constantly demands your attention, automation frees you to focus on everything else while your wealth builds silently in the background. Consider someone who manually transfers money into their investment account each month. Life gets busy. Some months they forget, other months they delay. Then a vacation comes up, or a market dip shakes their confidence, and they skip a contribution. Over time, inconsistency eats away at progress. Now compare that to someone who sets up an automatic deposit and never touches it again. No decisions. No delays. Just quiet, compounding progress. 10 years later, the difference is staggering. Automating your savings means treating investing like a bill. It comes out first, not last. It's non-negotiable. This flips the script. Instead of saving what's left after spending, you spend what's left after saving. That single change transforms financial behavior. It ensures your future is always getting funded. Investing can be automated too. Most brokerages allow recurring investments into chosen funds. This enables dollar-cost averaging, buying in at regular intervals, regardless of market conditions. Over time, this smooths out volatility and reduces the risk of poor timing. It turns the emotional highs and lows of the market into just another Wednesday. Rebalancing, the act of realigning your portfolio back to its intended allocation, can also be automated. Left alone, portfolios drift. Stocks outperform bonds, or vice versa, and your risk level changes without you realizing it. Scheduled rebalancing pulls everything back into alignment. Many platforms offer automatic rebalancing, and some do it within target date or robo-advisor accounts without any manual intervention. The beauty of automation is that it respects human nature. It anticipates forgetfulness, emotion, and distraction, and builds guardrails around them. Instead of hoping you'll do the right thing when the market tanks or your expenses rise, it removes the decision altogether. It creates consistency, and consistency is what compounding needs to thrive. Skeptics sometimes argue that automation removes flexibility, but flexibility without structure often leads to chaos. A system that runs on autopilot can always be adjusted. The point isn't rigidity, it's default behavior. When the default is building wealth, you win, even on autopilot. Adjustments become tweaks, not salvations. Automation also protects your energy. Every financial decision consumes cognitive bandwidth. Automating those decisions preserves your focus for other areas of life, your career, your health, your relationships. Meanwhile, your money is working quietly, hour after hour, day after day, asking for nothing in return but time. This is how wealth is built, not in bursts of brilliance, but in systems that work without constant input. The goal isn't to be more disciplined, it needs less discipline. Automation makes that possible. You can choose to operate your plan manually, checking in monthly, hoping you remember, hoping you feel motivated. Or you can automate the process and let your plan operate you. One creates stress. The other creates momentum. In the next chapter, we'll look at what it takes to protect your focus. Because no matter how sound your strategy, the world is filled with distractions designed to pull you off course. And the best investors aren't just systematic, they're selectively deaf to the noise. Chapter 6: Silencing the Noise, Tune Out, Build Wealth. Every day, someone declares the market is about to crash, or soar, or stagnate. Headlines scream urgency. Podcasts dissect every fluctuation. Social media rewards those who predict doom with viral applause. The financial world thrives on attention, not accuracy. And attention is expensive, especially when it leads to reaction over reason. Noise is anything that feels important but changes nothing. It's the daily chatter, the hot takes, the breaking news that breaks nothing at all. Most of it won't matter in a week, let alone in 10 years, but in the moment it feels urgent. That urgency is designed to bypass logic and trigger emotion, fear, greed, and anxiety. These emotions are toxic to good investing. Great investors aren't more informed. They're more selective about what they let in. They build filters. They recognize that most information is distraction wrapped in data. They focus on what matters, long-term principles, not short-term predictions. Consider this: over the last century, the market has experienced wars, recessions, political chaos, inflation, deflation, and everything in between. Through it all, it has marched upward, not smoothly, not predictably, but upward. Those who tuned out the noise and stayed invested were rewarded. Those who jumped in and out, trying to respond to every headline, were not. The cost of reacting to noise isn't just emotional, it's financial. Study after study shows that investors who trade more often earn less. Why? Because they respond to noise instead of sticking to a plan. The irony is that the more you try to manage the market, the more it manages you. Silencing the noise doesn't mean ignoring reality. It means recognizing what's actionable and what's not. A change in your personal circumstances, job loss, health emergency, or family need, that signal. A pundit's prediction that the market will drop 20% by summer is noise. One deserves attention. The other deserves your mute button. Start by curating your information diet. Unfollow accounts that promote constant urgency. Limit exposure to financial news. Schedule time to review your investments quarterly or annually, not daily. The less you look, the less tempted you'll be to act. And the less you act, the more your strategy can work. Noise is also social. Friends, co-workers, and relatives love to share tips, warnings, and stories. They mean well, but their advice is often based on emotion or anecdote. Your brother-in-law may have doubled his money in a speculative stock, but what's his plan? What's his risk tolerance? What's his timeline? If you copy his moves without copying his mindset, you're not investing, you're imitating. True confidence comes from clarity. When you know your plan, you don't need validation from the headlines. When you understand your why, the what becomes less volatile. A well-structured portfolio and automated strategy allow you to step back, breathe, and focus on your life, not the market's latest mood swing. This discipline becomes a competitive advantage. While others are reacting, you're compounding. While others are predicting, you're executing. Your quiet, boring, consistent approach starts to outperform the loud, reactive noise that dominates the culture. Over time, the market will do what it always does: rise, fall, recover, repeat. Your job is not to interpret every twitch. Your job is to stay the course, to trust the system you've built, to remember that most of what feels urgent is irrelevant to your outcome. In the next chapter, we'll shift focus from markets to the investor, specifically, the asset you can control completely, yourself. Because while money compounds over time, skills compound forever. And building those is the most underappreciated investment of all. Chapter 7: Your Skill Portfolio, Assets That Never Depreciate. Stocks rise and fall, markets swing on headlines, interest rates, and sentiment. But there's one asset class immune to correction: your skills. Unlike external investments, skills don't fluctuate with the economy. They compound quietly, invisibly, and relentlessly. Every hour spent mastering a valuable ability becomes a dividend-paying asset for life. Most people obsess over stock picks while ignoring their own earning power. They compare portfolios, debate fund performance, and track market news. Yet the greatest return on investment rarely comes from the market. It comes from increasing your value in it. A high-income skill, once developed, can outperform decades of average market returns, and unlike capital gains, it doesn't require capital to begin. Think of skills as your personal index fund. You may start with modest returns, slow, steady progress, but over time the compound effect takes hold. Each new skill builds on the last. Communication sharpens leadership. Higher leadership multiplies influence. Influence creates opportunities. The more you grow, the more leverage you gain, not just financially, but in freedom, choice, and resilience. Skills compound in another way. They unlock new levels of autonomy. The more valuable you are, the less dependent you become. You can negotiate better roles, freelance, build a business, or pivot entirely. When the job market tightens or industries shift, those with broad, deep skills adapt, others struggle. The economy may be unpredictable, but self-reliance never goes out of style. Not all skills are created equal. Some fade, others endure. The ones that compound tend to be transferable, timeless, and scalable. Writing, speaking, selling, coding, managing, and critical thinking. These travel across industries and outlast trends. They give you leverage in any field. They turn effort into outcomes. Investing in yourself isn't about collecting certifications or watching endless tutorials. It's about focus, deliberate practice. Choose one high-value skill and commit. Break it down. Study the best. And apply what you learn in the real world. Feedback refines. Repetition strengthens. Time compounds. The process is slow at first, then suddenly exponential. The return on skill investment isn't always immediate, but it's cumulative. It shows up in job offers, promotions, clients, and opportunities you never knew existed. Over time, the gap between those who invest in themselves and those who don't becomes impossible to ignore. One is waiting on market luck. The other is building market-proof income. Just like financial investing, Consistency beats intensity. 1 hour a day, repeated over months, transforms amateurs into experts. You don't need to be the best, you need to be good enough to be valuable, and valuable people are always in demand. Skills are also a hedge against fear. When you know you can adapt, create, or contribute in meaningful ways, uncertainty loses its grip. You're not at the mercy of a single employer, trend, or economy. You have options. And options are the currency of freedom. Most people undervalue themselves. They believe they are limited to what they currently know. But knowledge isn't fixed, it grows. And when directed intentionally, it compounds just like money does, starting slow, accelerating over time, and transforming your trajectory. The smartest investors don't just build portfolios, they build themselves. They treat their time like capital and their attention like a scarce resource. They understand that investing in skills today makes every dollar tomorrow easier to earn, keep, and grow. In the next chapter, we'll confront the enemy of compounding, debt. Because while skills move you forward, debt pulls you back, and unless addressed, it quietly undoes the very wealth you're trying to build. Chapter 8: Debt, the Anti-Compounder. Compounding is the quiet engine of wealth. It works slowly, almost invisibly, then all at once. But just as compounding builds, it can also destroy. Debt is compound interest in reverse. It doesn't just drain your money, it drains your momentum. While assets grow in your favor, debt compounds against you. It is the most efficient way to lose financial freedom. There's a myth that small purchases ruin financial futures. Skipping the daily coffee won't make you rich, and buying it won't make you poor. The real threat isn't lattes, it's loans. High-interest credit card debt, payday advances, and consumer financing, they pull your future earnings into the present at a premium. You're not just paying for what you bought, you're paying for time you haven't earned yet. Debt is often marketed as a tool, and in rare cases like low interest, strategic borrowing for education or a home, it can be. But the line between tool and trap is thin. What begins as leverage can quickly become a liability. The promise of buy now, pay later rarely discloses the full cost, mental stress, monthly obligation, and financial inertia. The psychological weight of debt compounds just as quickly as the numbers do. It introduces anxiety into every decision. It steals the confidence to invest. It crowds out your margin, the very thing you need to build wealth. Instead of your money working for you, it's working to catch up. And the longer it takes, the more interest grows, often turning small balances into financial burdens. Paying off debt isn't just a numbers game, it's a mindset shift. It requires recognizing that carrying balances is a form of financial drag. It slows progress, limits flexibility, and magnifies risk. No matter how well you invest, high-interest debt will likely outpace your returns. A 7% market gain is no match for 22% credit card interest. Trying to build wealth while carrying that weight is like swimming upstream with a backpack of bricks. The solution isn't glamorous, it's steady, strategic repayment. List your debts, smallest to largest or highest interest to lowest. Both methods work. The snowball method builds motivation by knocking out small wins early. The avalanche method saves money by attacking high-interest balances first. Choose the one you'll stick with. Momentum matters more than method. Automate your debt payments just like your investments. Set them to withdraw the moment your income arrives. Remove choice from the equation. Every dollar you use to destroy debt is a dollar you're reclaiming for your future. It's not just eliminating a bill, it's removing an anchor. Avoid the trap of trading debt for different debt. Balance transfers, refinancing, and consolidation. They can help, but they can also delay. They treat the symptom, not the behavior. Until spending habits change, the cycle continues. Debt freedom isn't a quick fix. It's a process of reclaiming control. Once the debt is gone, your margin explodes. What was once going toward minimum payments now builds assets. The same compounding that once worked against you now works in your favor. And with that shift comes peace, the kind that only comes from owning your time, your choices, and your future. The goal isn't just to be debt-free. It's to be opportunity-rich. When you no longer owe, you can build. You can invest without hesitation, take calculated risks, and design your life instead of reacting to bills. Debt is a form of financial servitude. Freedom begins when it ends. In the next chapter, we'll examine the truth about wealth building that few want to hear. It's not sexy, fast, or thrilling. It's boring. But boring is where freedom lives, and the ability to embrace boring may be the greatest investing skill of all. Chapter 9: The Boring Path to Freedom. The most effective investing strategies don't trend on social media. They don't involve moonshot stocks, crypto hype, or breaking financial news. They're not exciting, but they work, and that's exactly why so many people ignore them. The real path to wealth isn't thrilling, it's boring. But boring, done consistently, is what leads to freedom. Consider the habits of the wealthiest investors in history. Their portfolios weren't filled with speculative plays or frequent trades. They followed principles. They bought broad market funds, reinvested dividends, lived below their means, and waited. They weren't chasing adrenaline. They were compounding peace. Wealth didn't arrive as a jackpot. It arrived as a consequence of patience. Excitement often masquerades as progress. Checking your portfolio daily, reading market predictions, switching strategies based on the latest guru. These activities feel productive, but they're distractions. They keep you busy without helping you build. Real progress is silent. It happens while you sleep, while you live your life, while your money quietly multiplies in the background. Boring is misunderstood. It's mistaken for inaction when in truth, it's precision. It's the decision to automate contributions, ignore noise, and trust a plan. It's not laziness, it's discipline, and it's difficult. Doing less, when everyone else is doing more, requires confidence. It's tempting to believe that action equals control. But in investing, action often means interference. The market punishes those who can't sit still. It rewards those who do. The investor who buys a total market index fund, sets a monthly contribution, and forgets about it for 10 years will often outperform the one who jumps in and out, trying to optimize every move. Boredom is a feature, not a flaw. Freedom comes from predictability. When you know your plan is working, you don't have to obsess over every detail. You don't have to react to every headline. Your time and energy are freed to focus on what matters: your work, your family, and your health. Investing becomes a support system, not a stressor. The challenge is emotional. Our culture celebrates hustle, disruption, and instant success. A strategy that unfolds over decades doesn't fit the narrative. It doesn't spark dopamine. It won't impress friends at a dinner party. But it builds something they can't see: peace of mind, financial security, and eventually time freedom. The boring path also protects you from big mistakes. When you try to outsmart the market, you introduce risk, timing errors, emotional decisions, and overconfidence. Simplicity reduces those risks. It makes your plan durable, even during storms. And it's during those storms that real wealth is built, not because of what you do, but because of what you don't do. Boring scales. You don't have to constantly change tactics as your income grows or your goals shift. A simple, boring system expands naturally. Add more margin, increase contributions, and rebalance occasionally. The machine doesn't break, it adapts. That scalability is what allows wealth to grow without effort. There's wisdom in monotony. When your system is so well designed that you no longer think about it, you've reached mastery. Not because you're a financial genius, but because you've removed the need to be one. You've built something that works whether or not you pay attention. That's not boring. That's brilliant. In the next chapter, we'll explore the mindset that makes boring possible. Behind every disciplined investor is a virtue more powerful than intelligence or even income. It's patience. And without it, no strategy, no matter how sound, can survive. Chapter 10: The Psychology of Patience. Patience is the rarest asset in modern finance. Markets test it. Headlines erode it. Our culture mocks it. But no principle matters more. Without patience, even the best strategy collapses. With it, average strategies outperform. Because patience does what knowledge and skill alone cannot. It gives compounding time to work. Most people underestimate how long wealth takes to build. They start with enthusiasm, but enthusiasm fades. A market dip rattles their confidence. A slower than expected return stirs doubt. They wonder if they should switch strategies, try something faster, or follow someone louder. This is how short-term thinking derails long-term plans. Patience is not passive, it's an active form of strength. It resists the pull of urgency. It holds steady while the world races. It chooses not to react, not because it's unaware, but because it's rooted in conviction. It understands that time is the ultimate multiplier, and that breaking a plan for momentary relief sabotages future freedom. There's a famous study about children and marshmallows, one treat now, or two if they wait. Years later, the children who waited scored higher on nearly every measure of success. Investing is the adult version of that test. Can you delay gratification long enough for the real rewards to arrive? Most can't. That's why most never build wealth. Impatience looks rational in the short term. When markets dip, pulling out seems like protection. When others are winning faster, jumping ship feels smart. But the truth is, compounding punishes interruption. Missing just a few of the best days in the market can cut decades of returns in half. And those best days often come during the worst news. Patience requires a mindset shift. It means measuring success in decades, not days. It means accepting that progress is often invisible. Your portfolio won't thank you after a week of staying invested. But after 10 years, it will tell a different story, one written not in bold strokes, but in the quiet persistence of waiting. This mindset doesn't come naturally, it must be built. Start by defining what you expect. If you believe wealth should be fast, you'll be disappointed and tempted to quit. If you believe it should be slow, you'll stay focused and consistent. Expectations shape behavior. Behavior shapes outcome. Practicing patience means designing systems that reduce temptation. Automate investments so you're not deciding monthly. Check your portfolio quarterly instead of daily. Surround yourself with voices that reinforce principles, not predictions. Protect your mind as much as your money, because when emotion takes the wheel, logic gets thrown out. It also helps to remember the why behind your strategy. Wealth is not the goal. Freedom is. Freedom to spend time how you choose. Freedom to weather storms without fear. Freedom to say no. That kind of freedom can't be rushed. It must be grown, nurtured, and protected. Patience is what allows it to take root. Ironically, those who master patience often reach their goals faster, not because time moves differently, but because they stop starting over. They avoid the detours that come from chasing shortcuts. They eliminate the friction of regret. Every year they stay the course, the engine of compounding grows stronger. There will always be noise. Always a new opportunity, a hot tip, a scary headline. Patience filters it all. It says, I've chosen my path, and I'll stay on it. It is not stubbornness, it is alignment with truth. And that alignment is what builds resilience, not just wealth. In the next chapter, we'll shift from individual gain to shared wisdom. Because once you've mastered the principles, the next step isn't more accumulation. It's transmission. Teaching others how to build what you've built turns financial growth into generational impact. Chapter 11. Teaching a future investor, kids, friends, legacy. Wealth that ends with you is incomplete. The greatest returns come not only from growing money but from multiplying knowledge. Once you understand the laws of wealth building, the next step isn't to hoard them, it's to share them. When you teach others how to invest with clarity, consistency, and patience, you transform financial wisdom into legacy. Most people were never taught how money works. They stumbled into investing through trial, error, or desperation. Schools rarely teach it. Families often avoid it. As a result, generations repeat the same financial mistakes, living paycheck to paycheck, chasing trends, panicking in downturns. You have the chance to break that cycle. Teaching doesn't require a degree or a perfect portfolio. It requires clarity and compassion. You've walked the path. You've learned what works. Now you can illuminate the way for others. And the earlier you do, the greater the impact. Teaching a child about investing can give them a 30-year head start. Teaching a friend can reroute their entire trajectory. Start small. With kids, use stories and analogies. $1 is a seed. If planted, it grows. If eaten, it's gone. Explain compounding in simple terms. Money makes more money, and the longer you wait, the more it grows. Show them how saving today means freedom tomorrow. Give them a custodial account, contribute to it regularly, and let them watch it grow over time. With adults, the approach changes. They bring skepticism, habits, and fear. Meet them where they are. Don't lecture, ask questions. 1, 2. What's your plan for the future? What's your relationship with money? Use those questions to open conversations, not deliver sermons. People don't change from being told, they change from being understood. Modeling is powerful. When others see you living with margin, investing consistently, and ignoring noise, it creates curiosity. They wonder how you stay calm when markets dip, how you manage money without stress. That's the moment to share, not with ego, but with humility. Here's what's worked for me. Here's why I keep it simple. Here's how I stay consistent. Those seeds often take root quietly. Teaching also deepens your own conviction. Explaining why simplicity works, why automation protects you, or why patience outperforms timing reinforces your beliefs. It forces clarity. And clarity leads to confidence, not just for you but for those listening, confidence built on principle, not prediction. You don't need to convert everyone. Some aren't ready, some never will be, but your job isn't to convince, it's to offer, to be a reference point. When the noise gets loud or their strategies fail, they'll remember your calm, your system, your results, and then they may ask for help. Be ready. Legacy isn't about leaving money, it's about leaving understanding. An inheritance without instruction is often wasted. But financial literacy that multiplies, it shapes decisions, marriages, careers, and communities. A child who understands margin, time, and simplicity is more prepared than most adults. A friend who learns to invest consistently can rewrite their future. That is real wealth. You are proof that it's possible to ignore the noise, embrace the boring, and build steadily. By teaching others, you scale that proof. You create ripple effects that extend far beyond your own net worth. And in doing so, you elevate the people around you, not with charity, but with clarity. Your wealth operating system is the final piece. It's where clarity becomes action, and action becomes a life by design. Take care and be well.